When you invest in markets, there's this thing called the risk-free rate. And the risk-free rate is investing in like a United States Treasury bond or Treasury bill, because literally the government can literally just print more money. So if you get a 90-day T-bill right now, they're around 5% and something. You're going to get that 5% back, right? That's not going away. That in a sense is risk-free. You give them your money. They're going to give you your money back 90 days from now. You're not going to lose so long as you hold it for that period of time. In order for you to go invest in a market, a capital market, you need to get a rate of return that's higher than the risk-free rate. Otherwise, you wouldn't choose to do so.
Why would you do it? Yeah.
Wouldn't be rational, right? So when we look at markets like the US stock market, the S&P 500 on average has returned about 10% per year. Okay. And then the small companies in the United States have returned, let's just call it 12% per year. So by investing in smaller companies, now smaller companies are more risky. So I would expect a higher rate of return over time, right? But over shorter periods of years, those numbers don't always suss out, right? Sometimes the large companies will do way better than small companies and vice versa. But the point is that as you're investing like that, you're gonna see that what happens. Well, the point I'm trying to make is as the large cap stocks do really, really well, these tech companies are doing really, really well, and they're going up in price really, really high. It inherently makes it so their future return has to get smaller. Yeah. Compared to other things. Because if a lot of the returns already happened, it's very hard for it to keep going at such a high rate. It eventually has to come down. And we see it happen in capital markets again and again and again. What happens to most people with recency bias, not most people, but some people with recency bias, and this honestly happens with institutional money managers all the time. Yep. They see something's been doing really, really well, while something else did really, really poorly in the last 3 years. So they'll swap it out. They'll say, I want to invest more in the US and less in international. And then what do they see happen almost always, time and time again? The past does not predict the future. Because you just had higher rates of return in the United States, it makes it harder for it to have higher rates of return in the future. The thing that hasn't had higher rates of return recently has more probability of having higher rates of return because it hasn't seen the return yet. So it's counterintuitive because it gets back to the same thing we started with your clients of, everything's gone down, I'll sell it now. Oh, everything's up really high, I want more of it. Right. And that's the recency bias at play.
Right. And all that investment nerdery really can be summed up in the investing bromide of buy low, sell high.
Right.
You know, buy tech company you've never heard of, sell NVIDIA. Buy international stocks, sell US stocks. It's just that this is extremely painful to do because it doesn't at all match up with sort of our instincts.
So one of the things that now I think we're actually already at such an amount of time that I think we'll just splice this up into 2 episodes. But one of the things that you can do here is you can create for yourself some rules around how you invest. And we'll talk more about how we think about constructing a portfolio in the next episode. But one of the things that we'll teach you about, and we'll teach you in the next episode too, but there's this idea of a tolerance band. And what a tolerance band is it just says like, hey, I'm going to go invest in the US stock market and I'm just going to make up a number. I'm just going to say I'm going to invest 10%. Now, more than likely, I'm going to invest more than 10% because it's 60% of the world market, right? And we'll talk more about how to think about building a portfolio, but it's just for the example. Well, when we look at tolerance bands, especially for the stock market, a tolerance band of around 20% is a really good marker for when to buy and sell something. Okay. And so when I give a tolerance band of 20%, that means if I have a 10% position, I'm going to add 10% times 20% is 2%. So plus or minus 2% to my 10% band. So I'm going to say, hey, I'm allowing this position to grow to 12 or shrink to 8.
Shrink to 8.
Right. So within the portfolio, it's going to go up and down based on other markets and other positions I have. But if it crosses the 12% threshold, I'm going to sell it and bring it back to 10.